Do the Medtrans case first. It's a very important case. Do the chapter 5 and 6 handout. This one is combined. I don't know if I told you that or not before, but anyway, chapter 5 and 6 handout, and then we're going to start on monetary unit sampling. So today, let's start out with the Medtrans case. And this is a very important case, and I'll let you guys go ahead and read through it. You guys can see it, but it leads into what we're going to do today. Okay, so what a great client. Um, the Medtrans case. This is a very important case, and it's a very important case because uh, it set the professional standards, the legal professional standards, against the standards of, in this case, the AICPA, but anyone that um, any professional organization. Again, this goes back to excuse me, the we talked about before. The AICPA is just it's a club. You become a CPA. They say, "Hey, you want to be in our club?" And you say yes or no. What? But anyway, it's a club. So when you go into court and say, "Well, I belong to this club, and this club says that I should," it's a very weak argument. And the professional standards, I think we talked about this before too, that CPAs are considered professionals, and there's a legal body of laws around professionals: doctors, lawyers, accountants, therapists. There's any number of people who are licensed professionals, and those people are held to a higher standard than anyone else, and they're given a monopoly for auditing. It's excuse me for accounting for a CPA certificate. It's for doing audits. So you're given this monopoly, but there are strings attached. And one of the strings that's attached is you cannot leave your client, put your client in a worse situation basically than they were before. For example, an obvious one is a doctor. Doctor plans this operation, they go into the operation, and as they open this person up to do the surgery, it's much worse than they thought. No, can the doctor just run out of the room? Oh man, I didn't expect that. Take off. No. So we're held to these higher standards when you are a professional. And there's, again, and this goes with doctors, lawyers, accountants, and everyone else. And so there's a whole body of law around that. And so that's what we're kind of pitted against here. Okay, so we have this body of law for professionals that you can't leave your client in a worse situation. And then you have, these standards that are made by this club I belong to. So that was kind of what was going on in the courtroom. And obviously the up until this point, the professional standards would always prevail because, again, it's this club I belong to that says I should do this. So, that's kind of what the whole thing about this case was. Now, this case, it was decided in favor of Medtrans. They pretty much had to, with professional standards and the instructions given by the court. The unique thing is that this was overturned on appeal, and on appeal, it was established that they could, if they had, a good reason to, basically withdraw from the engagement, that they had that option of withdrawing from the engagement. By the way, this isn't just big for accounting. There's been many other organizations that have run into these professional standards that conflict with their professional organization. Therapists and all that, they all have doctors, and they all have their own associations that give standards for them. So it kind of opened the floodgates, and it really has been expanded quite a bit. That it's not just the professional standards of this whole body of law around doctors, lawyers, and all that kind of stuff. Also, these professional organizations, what they say can be entered in court as valid evidence. And so it was one on appeal. Okay, so this is a very important case. Now, as happy as I am that this case actually went through, let's go through a few things about it. So they find out that this place really had lost 500,000. So they show that they had a profit of 1.9 million. That was fictitious. They had lost 500,000. And they withdrew from the engagement. Where is that? firm withdrew from the engagement. Okay, so now they engaged two other audit firms, which were just started the third. So now they're on their fourth auditors. And they issued an unqualified opinion with the adjustments that Deloitte and Touche had made in the beginning. Okay, so now coming down here, what is the importance of the Medtrans case? The importance of the Medtrans case is that ACCT rules could be effectively used in court. If they say if they had good cause. So this is really what the and this again, this is a huge case because it opened the gates for other organizations too. You know, you may have like a therapist or something like that that stopped seeing a client or something because of whatever. And even though uh, even though the professional standards are you can't do that, it could very well be that their professional that their organization's standards could. Okay, now number two, though, this one is as happy as I am about the outcome of this case and how important it is. What course of action could Deloitte and Touche have taken to have avoided the lawsuit in the Medtrans case? Okay, so what could they have done differently? We know what they did. We know what they actually did do. They withdrew from the audit. What could have they done that would have maybe been a better decision? By the way, if you get taken into court, it's bad, no matter what. Because okay, yeah, they won the case. They won the case, and it did help overall. However, whenever even in a law case like that, you still lose because you paid all these legal fees and all this other stuff. There's no way they made a dime on that audit, whatever it was. So what could they have done differently instead of withdrawing? What could they have done differently on this audit? We know that they withdrew. You can put it in chat if you want. So this was the problem here. They withdrew from it. So they find out that they're actually losing. It actually lost 500,000.
They could have just completed the audit and issued their opinion.
Yep, that's exactly.
Instead of just throwing this audit away and leaving the client hanging. I mean, the client was unfair too. I mean, the CFO telling all that stuff to them, but unprofessional. But yeah, they could have just completed the audit and issued their opinion.
That's exactly right. It would have been better for them, certainly financially. Like I say, as happy as I am that this case actually came through, and we have this new law that this new opening in the law for the AICPA and other organizations like it. Yeah, you're hired to if you give an opinion to write an audit report, to give an opinion. You can do that. If they could have issued an opinion, an adverse opinion, right? saying, okay, this is misstated by these amounts of money and all this, and put that in the opinion and give them an adverse opinion. And there probably would not have been a lawsuit. It's anyone can sue anyone for anything, but most likely, and if there was a lawsuit, this gets thrown out. Notice that we give an opinion, and this is very important. We give an opinion. We don't give a statement of fact. We give an opinion. In our opinion, and then we go on and say what it is. So an opinion is very difficult to prove wrong. And and even in court, it's difficult to prove an opinion wrong. If I give you an opinion, this is going to sound ridiculous. If I give you the opinion that the color green is the best color, the color green is the best color. That's my opinion. You can't really prove that wrong. I mean, there's no, it's an opinion. Now, it is an educated opinion. It is an opinion based on work and
Evidence.
yeah, exactly. It has evidence backing the opinion. However, it is still an opinion. It's an opinion. It's not a statement of fact. So it's very difficult to go into court and say, unless you can prove some kind of gross negligence or something on the auditor's part, it's very difficult to go into court and say, I don't agree with this opinion. You don't have to. Maybe green isn't the best color for you, but it's very difficult to have arguments against a professional opinion. And a lot of times something like this would be thrown, you're hired to give an opinion, you gave an opinion, you completed the contract, it's done. So in hindsight, they probably, and certainly financially, they would have been better off by just issuing opinion, giving an adverse opinion. But yeah, so anyway, this is a very important case. And I think that it was just such an egregious case is why they, is what kind of changed the law. And like I say, it's helped everybody for all CPA firms going into the future. However, it is in withdrawing from a client, I can tell you, it's still a pretty serious thing. And it's serious in auditing because a lot of times there is a time factor. Okay, let's say they take inventory at year end. So December 31st, you go there, they take their inventory, you observe their inventory and all this kind of stuff. And that goes into your audit, your audit procedures and all that stuff, which we'll talk about today. That goes into your work papers and all this kind of stuff. Notice if you withdraw, the next auditor's coming in. They can't hop in a time machine and go back to December 31st and observe the audit. So in auditing, there is this kind of strange constraint that they don't have usually for lawyers or doctors or something like that, that it's time-based and and those are hard, the financial year for the client, December or whatever, January 1st through December 31st or whatever their year is. A lot of those things are based on year-end cutoffs, and you can't go back to the year-end. So there is this additional layer of difficulty, excuse me, when it comes to auditing. So you really have to withdraw from an audit is a pretty serious thing. Although the AICPA tells you should, sometimes you might see if you can work it out and at least get an opinion out of it. All right, so let me go back to here. Okay. So they probably should have issued an opinion rather than withdrawing from the audit. And again, I'm happy that they did what they did because it really fix things going into the future. But if you don't want to lose a tremendous amount of money, you're in a CPA firm, and usually they don't. You probably just should have issued an opinion rather than withdrawing. You're hired to give an opinion, give an opinion. Okay, there is a drop for this, I think. Nope, nope, that's wrong. Okay, let's see. Yeah, there's a drop for this in Blackboard. Okay, all right. Let's go on to the next thing. The chapter 5 and 6 handout. I just want to say something about the chapter 5, 6 handout. It seems kind of weird that we have 5 and 6 together. These are two chapters that in the past were huge. I had 20-page handouts for each one of them. I really cut it down quite a bit, which is good. We have planning and audit where you, excuse me, plan on what you're going to do to form an opinion for the client. You know, how are you planning the audit, how you're going to conduct the audit and get the evidence you need and all this kind of stuff. There's also a chapter on evidence, though. It's kind of a chicken and egg thing. You know, if you just get the evidence, you don't. If you do the evidence chapter first, it's hard to figure out why you're actually doing it, because it does. There's no plan involved. Whereas if you're planning it, you have to know what evidence you're looking for. So you have this kind of chicken egg. I've been doing chapter 6 first and then going to chapter 5, even though the book is laid out differently. So anyway, that's kind of the what's going on with this handout. So and there's also repetition between the two chapters that I tried to avoid. I cut it down though to still 20. No, 16 pages. Hey, you see that? Okay. So let's take a look at chapter 6. So this is what we're talking about. The chapter 6 is we plan the audit. And when you're planning the audit, you have to know like what you're going to, what's involved in an audit. So it's sort of like these down here are all what you do during the audit. So you plan the audit, and what do you plan it to do? You have to get an understanding of the client, know their business, know their markets, all that kind of stuff. 3 is assess the risks. What could go wrong? And we're going to talk about these going on. 4, perform further audit procedures, and these are I'll put in parentheses. To reduce the risks. So once we find out what these risks are, we then do audit procedure. Okay, well, you know, what could go wrong? Well, their inventory could be off, their blah, 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 whatever it is. And then we do audit procedures to reduce these risks. So we find out what could go wrong, we do procedures, we complete the audit. There's some completion stuff that we're going to do, chapter 16, and then we form an opinion and issue a report based on the audit. Okay, so some of this is just kind of general. We have 2 different financial statements here. We have the income statement, and they have revenues and expenses. And we have a balance sheet, and they have assets, liabilities, and equity. And which one of these would be the easiest to prove? Where am I? Here we go. If you had to prove something, we have these 5 different accounts. We have the revenues and expenses. We have assets, liabilities, and equity. By the way, accounting is really, it really is kind of interesting in that every transaction we can think of falls into those 5 categories, basically. I mean, we have revenues and expenses. In revenues, we could also have gains. In expenses, we could also have losses. But, you know, everything fits into 5 categories. It's kind of crazy. The most complex transactions you can think of fall into these 5 categories. Which one of these would probably be easiest to prove? And again, you don't need, if you want to put it in chat, that's fine.
Maybe assets.
Yep, assets. Yeah, if you think about, for instance, inventory or equipment, you can go look at that, right? I mean, if you're auditing Walmart, you can go look at their inventory. You can go look at their equipment, their buildings and all that other stuff. So assets are the easiest. Cash, you can look at the bank statements. So assets are where we usually start. They are the easiest. So we start with the assets. Let's see. And next thing we go to are liabilities. So this is where we start the audit. Assets, and then we go to liabilities and we prove those out. So we prove out the assets, and I'll talk about that in a second. And then we prove the liabilities. Now notice, if we prove the assets out, or get comfortable with the assets, maybe is a better way to put it, and liabilities, what do we know about the equity? If we come to the conclusion that these two are fairly presented, the assets are fairly presented and liabilities are fairly presented, what does that tell you about the equity account? Because these two sides have to equal. Put an equal in here. Assets equal liabilities and equity. So if assets are fairly presented and liabilities are fairly presented, what do we know about the equity account? The equity accounts. At least in total, they must be fairly presented.
Yeah, they must balance with the other accounts.
Exactly. If these two are okay and the balance sheet balances, and it should, then we know that the equity accounts, at least in total, that they are okay. So by proving the assets and liabilities, the equity account can be proven. Now notice something else here. I'm going to come over here to, what should I do? I'll make it in red. Notice the income statement. We have revenues minus expenses. We get our net income. It doesn't look like it's bold, but I guess it is. Well, net income goes into the retained earnings. So notice when we prove out these two, part of it, we're proving out that the net income's there. Dividends are easy to prove, usually. But notice that the net income, we may not know exactly if the revenues and expenses are 100% in line, but whatever they come up with for the net income must be okay, because the equity portion of the balance sheet is okay. So we can actually prove out quite a few things here. We usually start with the balance sheet. And once we do the balance sheet, then we prove out these other ones. Spacing might get funny. Okay. Oh, no, it's really funny. Okay, now I'm going to talk about one more thing here, though. Let's see what change this back. Okay, let's take an account like cash. So we get our bank statements, we can show, this shows how much cash we have, right? So cash is actually one of those accounts that we can actually audit, usually, oftentimes to 100%. Even if they have, you look at Walmart, they probably have thousands of bank statements. You can get thousands of bank statements. That's not, you can actually do it. And for a big audit like, Walmart, it wouldn't be that big of a deal. It probably spends a day putting all the financial, bank statements together for the cash. So you can prove out the cash, by the bank statements. Now, when you prove out the cash, notice there's some sales that you may have that are cash, right? So while you're proving out the cash account, you're also proving the revenues, because some of the revenues will be in cash. And you may say, well, what about sales that aren't made for cash, that are made on account? Okay, that'll be accounts receivable. When you get accounts receivable, when people pay those off, it goes into cash. So looking at the cash account, you can also prove out the accounts receivable. Same thing with expenses. The expenses that are paid in cash are more likely, they're probably going to be paid with on account. I'm gonna take a long way around the barn here. Ah. Okay, so expenses. We have accounts payable. Whatever it's for. It could be for inventory. It could be for electricity. It could be whatever. Okay, well, eventually you pay those off. What do you pay them off with? You pay them off with cash. So basically, everything that we, cash is a very important account. And if we can prove cash out, and then go through the pluses and minuses into the cash, almost everything on here we can prove. It's hard to imagine a transaction that doesn't go through cash. You really have to be creative to get a transaction that doesn't go through cash. Maybe if you give somebody common stock and they give you land or something, I guess, that would be something, but those have got to be pretty rare. Almost all transactions, you buy equipment. Okay, if you buy it outright, it goes out of cash, goes into equipment. If you get it on loan, okay, you get a loan. The loan, you get the equipment, but then you pay off the loan with cash. So it proves out that loan. Paying off for cash, and the loan matches the equipment. So cash can be used to prove out almost every account on there. Again, there are some transactions that don't involve cash, but they're very, very few that don't involve cash. So one of the reasons why we beat up the balance sheet is that if you can prove the assets, you can prove the liabilities, all these other accounts will kind of fall into place, and that we've proven those out. So the balance sheet really gets beat up when we do an audit. And cash is probably the most important one that we do, but there all these other ones too. We'll do procedures for them. And cash is oftentimes a smaller account compared to the other ones. If you look at cash compared to equipment or inventory, a lot of times it's very small, but almost everything goes through it. So if you audit cash and you can trace everything going through it, a lot of times it just proves out these other accounts that may be very difficult to prove otherwise. Okay, so the audit plan, client acceptance. The Medtrans case is a good reason why we do this. Client acceptance. Think about the Medtrans case. We do not just take any client. Unlike other, for instance, doctors are required to, when somebody comes in need, they're required to help them. It's part of their Hippocratic oath that they must help anyone who needs help. We're not like that. Auditing is actually a very strange profession in that we pick and choose the clients that we have. And I think I talked about this before, maybe I did, I don't know. But the integrity of management is absolutely huge when it comes to picking. You do not want to be associated with people of ill repute. And it's not just because, you have morals. It's also because all we give is credibility to the financial statements. And if we are, if we have these clients of ill repute as our clients, that takes away credibility, takes credibility from our other clients, it takes credibility away from the profession. So the integrity of the client is absolutely the top thing when it comes to picking a client.
Professor, can I ask you something?
Yeah.
So when a CPA firm has a new client, acquires a new client, do they do like a background check or something like that to see if the client is someone that they want to work with?
Absolutely. And absolutely. And that's what makes us very different than other professions. Or just any other business. Like I say, you go into McDonald's and you want a hamburger, they don't care what your background is. They don't, they'll sell you a hamburger. We're not like that. Because all we give is credibility to the financial statements, we have this level of acceptance that has to be met. And there are clients that they can't get CPA firms, because of who's running it and whatever, that no CPA firm will go near them. And it's difficult to have a lawsuit on that because, again, it's you don't have to take them on as a client. Here we go. Okay, so first thing we do when we're looking to see if we should take on a new client is a CPA firm qualified? Okay, so here's a this we go to, like, for instance, if they have experience. So if let's say that you have a client, someone comes to you and wants to be, you to do their audit, but you haven't audited a company, a client like them. Can you take it? Okay. Hey, what happened here? I thought I had it. I should say, hey. CPA firm may take a client that is in, oops. That is in a business that the CPA firm has no experience in. If the CPA firm reasonably, oops. Yeah. You gain the expertise. Audit. Okay, so you can take. So let's say that there's a flower shop that wants that needs an audit. They've grown, and their bank says, "Hey, you're big enough now. We need to get an audit." And I didn't complete. Look, I didn't. I didn't complete the audit. Okay. So you can take a client that you don't have expertise in if you reasonably suspect that you can get the expertise you need. Okay, and you can get it through online. You get it online, seeing what other people did for the audits. You could hire an expert to come in, find somebody who has done audits of, let's say it's a flower shop. Find somebody who's done audits of flower shops, bring them in as a to help you. Now, So here's the thing. People say, well, you shouldn't do it unless you have extra expertise. Well, then you got the chicken and egg thing, because no one will. It doesn't make sense for me to learn how to audit flower shops if I don't have any clients that run flower shops. It'd be kind of strange for me to, to research that I could, I should learn how to audit flower shops. I don't have any clients that do that.
I was just thinking about it. It would be almost impossible for the CPA firm to know every single trade right off the bat in every single business.
Yeah, exactly. Auditing banks, auditing
Yeah.
banks or insurance companies or whatever it is. At some point, you got to make the plunge, into it. And again, it'd be strange to do an audit, to get the expertise to do an audit if you don't have any clients in that field. So it isn't that unusual to do it. And as long as you feel that you can get the expertise you need, you can do it. If you don't feel like you can, if you don't feel like the audit can be completed, then you must walk away from it. So, if the flower shops, I'm sure that they have time is probably a big thing, that they get flowers when they're fresh, and then if they don't sell them immediately, then they turn, from an asset into a garbage or whatever. So, I'm sure there's things that go on with it, but if you can complete the audit, if you reasonably expect that you'll be able to complete the audit, you can take it. Okay, legal and ethical requirements. We're not going to go into this. This is all chapter 3. We talked about this for weeks. This is chapter 3. Independence and all that kind of stuff we already know. Okay, integrity and reputation of the client. And again, this is the ACCT says this is the most important thing. You cannot be associated with clients of ill repute. Because it hurts the profession, it hurts your business, and it takes away our credibility. And that's the only thing that we offer for our service. Okay, you'll often see and talk about auditors as the successor or the predecessor, and let's just go over who they are. The successor auditor is the new auditor. Oops. So if there's if you have a change of auditors, or if they didn't have an audit before, it's the new auditor. The successor will be the new. I guess it wouldn't be a successor, just be the first auditor. The predecessor auditor is the old auditor. Oops, it should be bold. Okay. Now, if you are the new auditor, you must contact the predecessor auditor if one exists. And this is done before you accept a client. So you talk to the previous auditor. Now, you generally don't talk to them about audit procedures. You don't say, well, what was cash like, or what was any quirks? You don't do that. You're going to do your own audit. You're going to form your opinion based on your audit. You don't talk about the details of testing and all that kind of stuff. You talk about things like management. What's it like dealing with them? What's it like dealing with the audit committee? What's it like dealing with the board of directors? Those kind of integrity-based things, not how do you do this and what did you do for this part of the audit. Those generally that you don't talk with the predecessor auditor about. Okay, the 8K report. There's actually one of these on the next page we're going to look at. But this is what you talk with the predecessor auditor about. Integrity of management, probably the most important one. It is the most important one here. Can you trust these people? Reason for the change, whatever it was, any disagreements with management, how I was working with management, board of directors, anything unusual about the organization, related party transactions. You run into a lot of these things if you, especially for like, usually for smaller companies, you'll, it's not unusual to look at a small company's books and you see that there's an auto loan to grandma, on the books or so, you get kind of these kind of strange things sometimes, but you're really just trying to get a feel for what the client is and in their integrity and if you can actually do the audit. Okay, one of the things you always keep in mind, the spacing weird here. Okay, shopping for accounting principles is when the client looks for a CPA firm that will agree with a disputed principle. So this is one of the things they try to avoid. This happens when you have a disagreement with the auditors. So you have a client that wants to account for something a certain way, and the auditors say, no, you can't do that. And they say, well, you know what? You're not the only CPA firm on the planet. We'll find another one. And so they call up other CPA firms. They say, oh, by the way, when we account for whatever it is, we do it like this. Do you have a problem with that? That's shopping for accounting principles. And that's a big no-no. The AICPA tries to discourage that. And they want you to be aware of that if a client's doing that. If they start asking you about specific accounting rules, as far, that's a red flag that this is somebody who's had trouble with their auditors in the past. And they're looking to shop for accounting to find somebody that'll agree with what the way they want to do it. Client continuance is this: after you get a client, you want to continue with it. For instance, I doubt the Medcan case, they want to continue with that. You want to do Medtrans audit next year? No, I don't think so. Okay, so these are some of the things where you look at. Again, you take a client, you want to make sure that they have integrity, that you can actually believe what they're saying, and all that kind of stuff. Okay, Form 8K. Now, this is only for publicly traded companies. This is only for issuers. If they're not issuers, they don't deal with the Securities and Exchange Commission. The 8K report is not just for change of auditors. The 8K report is whenever something major happens with a company. So, yeah. So, for instance, they get a new president. They're going to file an 8K with the SEC. We've got a new president. This is the old one left. Here's the name of the old one. The new one came in. Here's the name of the new one. When they have if they merge with something. Okay, we merged with one of our competitors. We bought out the smaller firm or whatever it was. This is the firm. This is what we, when we did it. And so now what we, anytime there's actually a change in the company that is significant, a company must fill out an 8K and turn that into the Securities and Exchange Commission. So it's not just for changing auditors. Changing auditors is one of the reasons why you fill out 8Ks, but they could have dozens of 8Ks in a year. And I've seen companies that have had dozens of 8Ks. Chief financial officer leaves, it's an 8K. You get a new controller in, it's an 8K. You get a upper level operations director, it's an 8K. Anytime that there is something significant that happens in a company, an 8K is filled out. But one of those things is if they change auditors. So if a publicly traded company changes auditors, they have to tell the SEC about it. Okay. And so that's what this is. This is an 8K. This is an actual 8K. It's a little bit dated now. It's from 2014. Hey, that's when I was born. So this is an 8K. It looks like we have, what is this? Honeywell. Okay, so Honeywell is changing their auditors. blah, 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 legal stuff. Okay, so it looks like they approved Deloitte and Touche. And they dismissed PricewaterhouseCoopers. Okay, so Deloitte Touche came in, PricewaterhouseCoopers went out. So this would be the this is the successor. We're a 2-season successor. We'll soon find out. And this is the predecessor. I know why this is. This is I actually did some formatting. I couldn't understand why this was formatting strange. This is right and left justify. There we go. See, now it looks normal. Okay. Although now I've lost a line. Okay. Blah blah blah. A few things you'll see in here is that they don't tell why. A big one here, there's no disagreements. And PwC furnished a letter. And I'll tell you what that means in a second. Okay, a few things about the 8K. It does not give a reason for a change. You don't have to explain yourself. You're just saying, look, this is the old auditors, they're going out. Here's the new auditors coming in. So you explain that. You do not have to list what you paid them, none of the financial agreement, statements and all that kind of stuff. What you do have to disclose are any disagreements that you had with the CPA firm over the last 3 years. And this is where it gets a little bit legally, is that the Securities Exchange Commission will ask if there's any disagreements with the previous auditors. And it's required that whoever this client is, that they file that they have any of the disagreements they show. The SEC then takes that list and gives it to the predecessor auditors and says, is this everything? And it's a yes or no. It isn't, they don't add anything onto it. They either just say yes or no. And if they say no, it's not everything, then the SEC goes back and says, well, keep writing. Apparently there's something else that you guys disagreed about. And, they're trying to get the most information they can surrounding it. So when they say that there's a letter on file from PwC, that means that PwC signed off on it, said, yeah, there was no disagreements. So when they say there's no disagreements and then they say they have a letter on file, that means that PwC said, is this everything? They said, yes, that is everything. Okay. So anyway, this is an 8K, and this is, if you're a publicly traded company, that when you're looking to get a new client, you're definitely gonna look to these and see what they are saying about that they would, for the reason for the change. Okay. Oh, okay. I don't think I talked about those. Communicating with the predecessor auditor. So the new auditor coming in, is required to contact the predecessor, not the other way around. The old auditor has no duty to contact the new auditor. So the attempt to communicate between them should be initiated by which one? Who should initiate
The
the,
successor?
yep. Yeah, so this is the new auditor and this is the old one. Yes, the successor auditor must contact the old. The old one has no responsibility to contact him. And by the way, this is confidential information that they have, so they also have to get cleared by the client. So the predecessor auditor will say, yeah, I'll talk to you about them, but you need to get there's a standard form for clearing the, so that you can talk with the predecessor auditor. But the successor auditor has to get that. All right. The communication between the successor and predecessor should be made before or after?
Before.
Yep. The successor auditor would likely inquire about which of the following. It could be more than one here. Obviously, there's more than one. Disagreements with management. Would they want to do that?
Yes.
Yep. So we're going to do that one. Specific audit program steps. Probably not. Communications with management.
Yes.
Yep. Reason for change in auditors. Yeah, and again, the reason for change, it could just be that the previous CPA firm just doesn't want to do the audit anymore. It doesn't necessarily have to be a bad thing, but it can be. Communication with those in charge of governance, board of directors, audit committee. Yeah, you want to tell what's it like working with, the oversight. And by the way, this is those are generally called governance. You won't see those usually called board of directors, audit committee. So when you're taking a CPA exam, if they say governance, this is what they're talking about. Governance is, these people who are in an oversight role. Reasoning for specific testing of accounts, no. Integrity of management, this is a big yes. We're going to bold it. That's how big it is. And this one is probably the most important. Well, it is the most important on here. Okay. AK report for change of auditors. What's the following items? I'll do the first one. That one's easy. Predecessor and successor, yes. Reason for the change?
Yes.
Actually, no. You don't have to tell them why you're doing it. You're just telling them that there's a change. You don't have to tell the fees. This one is technical. Significant disagreements with the predecessor over the last 5 years. The next one is over the last 3 years. Which one is it? I think I told you that one, didn't I?
E.
Yeah, yep, very good. Yeah, it's for 3 years. And the predecessor's response to the disagreements, that will be on there. Now, they'll have a letter. They'll say we have a letter on file. Which of the following are considerations important when obtaining new clients? A, reputation of owners, directors, officers, management. Yes or no? Well, you guys,
Yes.
you get 21, yeah. Yeah, the whole thing, their reputation is, it goes with the integrity of them. The nationality of the owners.
No.
Nope. Credit rating of the client. This one is not as obvious. That is actually something you will do. And I'll tell you why in a second here. So the credit rating of the client is actually one of the considerations. And you might ask, well, why? Why do you care about their, the credit rating? If they are, if they're, if a client is struggling, let's say that they're missing payments or whatever, if they are struggling, if there's a possibility of them going bankrupt, that has an impact on the risk. Clients that are going bankrupt have a more of an incentive to try to cook the books or do something underhanded. Not that they necessarily would, but there is a bigger risk involved that rather than a company that's doing well. The company that's doing well, there's less pressure on them to cook the book. They don't need to cook the books to get a loan, right? Whereas a company that's struggling, they may really need a loan and they may think that they have to cook the books to do it. So it doesn't necessarily mean that there any reflection on the people, but it doesn't show it doesn't there is a higher risk involved if there's a client that is possibly going bankrupt. Another thing to consider too is a lot of times if a client does go bankrupt, the only suing the client, if an investor is suing somebody, suing the client that's bankrupt is probably not the best thing to do. They're bankrupt, they can't pay you anyways. Who's left standing? The auditors. The auditors are the ones that can get be sued. Okay, so credit rating actually is important. How about marital status?
No.
No.
Pending litigation, lawsuits, things like that.
Yes.
Yep. Independence to the audit of the auditor to the client.
Yes, that's important.
Yep. That's chapter 3 stuff. And the auditor's competence in the client's industry.
Yes.
Yeah, it is important. Now, again, we talked about this earlier that if they feel like that they can get the knowledge base they need to complete the audit, they can still take the audit. But it is a consideration. Okay. What time is it? Oh man, I'm going to stop here. Let's stop here. And I do want to get into monetary unit sampling. Okay, so monetary unit sampling, we'll do this next. Let's say be back at what time? 7:06. Let's say be back at 7:16. Okay. All right, we'll go ahead and get started on monetary unit sampling. There's a few different names. I'm not going to go into them right now, but monetary unit sampling is a type of sampling. This is for auditors only. Oops. There's a very specific type of sampling that is only used by auditors. And it, for some things, it's really good. For some things, it's not. But for some things, it's really good. So, for instance, let's take this case as our example we're going to use to kind of see how this works. So we have the following data for accounts receivable. And here are the items and our book value of each item. And this middle column here is just the running total. And let me show you what I mean by that. So for instance, the first one is just the 500. The second one, we have the 500 plus the 200. You know, and it just keeps adding on. So 700 plus the 600 equals a 1300. You know, so this is just adding them all up. We come down to the end here, and this is the total for the accounts receivable. So the accounts receivable actually has, it's got $5,000 in it. Oops, that's and so this is what we're looking at, trying to prove to see if they have $5,000 in this account. So the accounts receivable, and this is the running total, add everything up, and it comes out to $5,000. A sample size of 5 items will be selected. Okay, so I am now going to go to my archaic overhead camera. Okay. So this is what we have. We have accounts receivable. Sorry. Been doing work on some stuff, and I got about 5 screwdrivers on my desk right now. Okay, so here's what we're going to do. We're going to take this accounts receivable for $5,000. And we're going to break it up over 5 items. And this is how we're going to kind of break it apart. So what we're going to do is take each, what we call intervals, and break it up into $1,000 chunks. And what we're going to do is pick one item to represent that entire interval. So we're going to pick one item in this interval and pick that and say, okay, that item is going to be for this entire interval. And it's almost like a ratio estimation, but you're doing it with one item and you're doing it for one interval. So, we'll pick, this will be item 1. This will be item 2. This will be item 3. And I see where this is going. So we're going to take 5 items, and each one of these items is going to represent this entire interval. So that's kind of what we're doing, kind of a little visualization, whatever you want to call it, for it. Okay, so find the sampling interval. I just did it. The sampling interval will be the total. Divided by the number of items. And we're going to use the cumulative book value to figure this out. Okay. So let me get rid of this stuff here. We are looking for whichever item moves us past the first 1,000 interval. So of all these items here, going to the cumulative, which one goes over the $1,000 interval?
Item 3.
Yep. Very good. So item 3, it's item 3. This one puts us over. So this will be the first one that we pick, is item 3. Which one puts us over the $2,000 interval? Yep. And the $3,000 interval?
Eight. Actually, 7.
Yeah, I think so. Yep. And 4,000. 9. And then the last one, let me get rid of this. Hold on. And then this would be the 10, item 10. Okay, so these are the 5 items we're going to pick. 3, 3, 6. Wait, that's not 5. Yeah, it is. 3, 6, 7, 9, 10.
Professor, a quick question. Why do we choose this number? Is it random or why?
That's an excellent question. I'll tell you why we do it. What we're looking for the number that goes into the next interval. And there is a randomness to it. However, it's more likely that the bigger accounts will be picked rather than smaller accounts. So one of the reasons why we do it is that we want to find the bigger. It's not that, it could be a $1 account that goes over. However, it's more likely to be a larger one. So we're looking to it'll automatically pick the larger items to pick for the entire interval. So while it might be random as far as which one is actually picked, the larger dollar ones are more likely to be picked. And just to
So we pick the number based on book value number?
exactly, their likelihood of being picked is based on that. And
Okay.
yes, and it actually is an important feature. I don't know. I'll tell you about it right now. Actually, notice that if you have an item that is worth more than the interval, if you have an item that's more than 1,000, it's guaranteed to be picked, right? If I had an item that was $1,200, it would absolutely cross at least one interval. It might cross two, but it would, if you had a $1,200 item, it would definitely pass it. And so this is kind of the beauty of this method. The beauty of this,
Okay, Professor.
yeah.
No, it makes sense.
Yeah. So here's the beauty. So if you have a client that is, committing a fraud, let's say they are increasing, adding fictitious sales on. Let's say they're trying to make their sales look better. The more they increase an item, an account, the more likely it is to get picked. And at some point, if they increase it over the interval, it's 100% sure it's going to get caught. Notice that's different than random sampling where you can pick any number in the, in the thing, and they may be big, it may be small, This one, it goes big, and if they get big enough, first of all, if they increase it anything, it increases the likelihood of being picked. But if they go over the interval, it's 100% sure. So this is actually a very good one if companies are overstating something. Because the more they overstate it, the more likely it's going to get caught. And if they overstate it enough, it's 100% sure we're going to caught. So yeah, they used to call this probability proportional to size, which is a lot of words. But what it means is that larger ones are more likely to be picked than smaller ones. So the probability, if a $100 account is 100 times more likely to be picked than a $1 account. So the probability of being picked is based on dollars. This is kind of a unique way of sampling too, because each dollar is actually each dollar is is a unit. Each dollar has a possibility of being picked. The dollars all have equal value of being picked. If they're grouped into accounts, means that account would have a greater value probably being picked. But the exact dollars, the dollars are, a dollar's a dollar. It's also strange in picking the sample size, and that if everything is a dollar, there's no variation. There's no standard deviation. Everything's a dollar. A dollar is the unit, so it could be monetary. It could be a euro or whatever. But yeah, so it's kind of a strange way of sampling, and there's advantages and disadvantages to it. But yeah, it's so that we're picking the ones that they usually come out to be the bigger ones. Okay, so let's see how this thing works. Let's take the first one. The book value is $600. The audit value is also $600. Okay, so this is item, what is it, 3? 3. So item 3, it's audit over book. So this is the audit. And this is the book. Now we multiply it by the interval. Oops. Hey, ooh, I didn't put a dollar amount in there. Let's put that in. Okay, so the audit amount and the book amount are the same times the interval. This will give us a projected value of this. So everything's okay here. So this is just 1 times 1,000. So projected value would be 1,000. And the misstatement would be 0. We're saying everything is okay with this one. The audit is exactly what the book is. So we picked one item, they're representing the entire interval, and everything's okay, we have no projected misstatements. Let's go to 6. Get this on the same page. Oops, on the same screen. Okay, so the next one we're going to pick is number 6. The audit amount is 560. And the book amount is 800. So there's a difference here. So this one is going to be a little bit of a problem. Let's make that green. So again, it's sort of like a ratio estimation, audit over book, times the interval, and this will give us what our projected value is for this interval. Calculate, okay. Oh, here we go. All right. So, sorry, 560 divided by 800. Point 7 times, so what is it, 700? So we're saying that this book, the audit over the book value, so we're saying this interval, I should say, is worth 700. So of this $1,000, we're saying it's worth 700. So how much is it misstated?
$300.
So this is misstated by 300. All right, let's go to 7. The audit value is 450 and the book is 450. Okay, so this one's okay. So the audit value is 450 and the book one is 450. So this is sort of like the first one, everything's okay with it. And there's no misstatement. Let me take yellow one off. So yellow will be okay and green will be bad. Okay, so so 9 is the audit amount is okay, 9 we have a problem. The audit amount is 300 and the book amount is 750 for that item. Okay, so audit and book. You don't have to write this audit book in there. This is what we're doing. 750. Okay, so I'll make that green so I know that it's a problem. So this is, which comes 1,000. 400. And so the misstatement is how much?
600.
Yep. Yeah, so the misstatement says 600 on this one because again, and by the way, notice what happened here. You know, they increased the value of the book, you know, $450 over. So that was enough to get this one caught. You know, if they left it at 300, we would have picked number 9. Okay, so now what's the last one? 909. Okay, so this one's the same. Okay, so audit and book is the same. Okay. So that's for a projected misstatement. Find a projected misstatement that is 900. Yeah, so the projected value would be, well, it's 5,000. It should be like 4,900. No, 4,100. So 4,100 would be this. It doesn't ask for it, but so 900 would be the projected misstatement. So this would be what we would have here for our projected misstatement would be 900. And two, if you look at it, so for instance, taking this number 9, it was it should have been 300. They increased it to 750. That was enough to put it over into the next interval. You know, only clear the next interval by 100. So the more that they try to overstate something, the more likely it's going to get caught. In this case, number 9 got caught. Did number 6 get caught because of it? No, number 6 would have been caught anyway. Would have been picked anyways, I think. Yeah, number 6 would have been caught anyway. But number 9, because they increased it right into being caught. And that's kind of is the beauty of this method. Now, there is another, but this is only for overstatements. I'm going to put that right in up here. Say overstatements only. Or maybe only overstatements is a better way to put it. Because you'll let's see. Only overstatements, because you'll hold on a second. If they were to decrease these, you know, if they put their book value down and lower than it really is, there would be no chance of it being picked. You know, if you put the value down to 0, there's 0 chance of it being picked. So this is only for overstatements. So when it comes to you know, what do you use this? It's only for overstatements. You know, testing things like revenues, testing things like it could be cash, it could be accounts receivable or inventory. Those things that would be positive. Are we using for things like accounts payable, things that they don't want on their books? this is a bad method to use because especially if it goes, the lower that the more understated it is, the less likely it's going to get picked. If it goes down to 0, you're never going to pick it. So this is only for overstatements. And this is only for auditing too. This isn't like the classical sampling where you have a mean per unit and it was like, okay, you could use this for measuring the average size of buffalo or whatever. This is only for auditing. So it's for audit. It's only for auditing, and it's only for overstatements. And it does really well at that, but everything else is not very good at. Okay, we're going to go through one of these. How do we pick the sample? Oh, I know what I want to do. One more thing I want to talk about. Not only does this method is it great for finding overstatements, but it also picks your sample for you. We're not going to a random number table. First 2 digits or whatever. You don't need to do that. It's whichever one crosses that cumulative threshold, whatever one crosses that interval, that's the one you pick. So it also picks your sample for you, which is big. It's picking the ones that are likely to be overstated are more likely to be picked. Okay, now here we get to the ugly part of it. I might as well introduce it to you now. We should be able to do this one. We'll do this one, then we'll call it a night. We have some wacky tables at the bottom of page 2, that we're going to use. There's 2 of them. There's reliability for this one. Let's make that one yellow. And the expansion. A little something hanging out here for no reason. I don't know what that is. Okay. So we have these 2 tables, and what we're going to do is figure out what would our sample size be. This is how we determine the sample size. Because notice that up here, it was given to you at 5 items. Well, notice that the size of the sample makes a difference because it also makes for the sampling interval, right? The number of items will make what the sampling interval is. So the sample size is important. So that's what we're doing down here. Okay. So let's look and see up here which ones we can actually get. Total population book value, we can get this one up here. Nope. We got the tolerable misstatement. And we got the expected misstatement, and then we'll figure out these other ones in a second. Okay, so total book value, coming down here to find the sample size. Total book value is 1,600,000. The tolerable misstatement. So this is the amount of misstatement that we will allow for. This is kind of the allowed amount. So we're saying that if this was misstated by 120,000, that's a judgment call, we would be okay with it. So this is the total amount that we would allow for our misstatement to be. Our expected misstatement, and this might come from the previous year. Oops. How do you come up with the expected misstatement? If this is a second time you did the audit or more, previous years is a good one to use. 5,000. Okay, now we got to go to the wacky tables. And the first one is reliability factor. At 0 overstatements. Come down here. Here's a reliability factor. here's our zero overstatements. And I need something else. I need to find the risk of incorrect acceptance. Hey, it's right there. So risk of incorrect acceptance, in other words, we want to be 95% sure. Okay, so I'm going to get rid of these two. So 3 is our reliability factor that we're going to plug in up here. And we also need our expansion factor. Down here, the expansion factor. Now, the expansion factor is easier to find because it's just one row. 1.6, so 5% incorrect accept. Wait a minute, how come I got these the same color? Sorry about that. My color coordinating is not what it should be today. Okay, so expansion factor. So 1.6 will be our expansion factor. Okay, so we're going to multiply 100 or 1,600,000 times 3. I'll use my calculator. This calculator is so bashed up, I'm surprised it works, but it does. $1,800,000. For this one, I would take this first, this down here, this multiply this first, and then subtract, take 120 minus whatever this comes out to. So 5,000 times 1.6, whatever that is. 8? It's 8.
Yes, the answer is 100 1,200,000.
Yep. Yeah, this comes out to, I'm just gonna write it here. This comes out to 8,000. So 120 minus 8,000, yeah, is 112. And so we're going to divide that. I turned up my calculator, now it doesn't want to come back on. Divided by. So 42.857, blah, blah, blah. So 42.86. Now we can't take 0.86 of an item, so we're going to round this to 43. So this is going to be our sample size. Round it to the nearest whole number. So we're going to take 43 items. And coming out here for sampling interval, we're gonna do the total book value. 1,600,000. And we're gonna divide it by our number of units that we have, items, 43. Let me insert my okay, so 1,600,000 divided by 43, whatever that comes out to. That's not going to be a nice number. I'm going to round off to the nearest dollar, 37,209. Is that right? 37, yeah, 37,209. I just rounded off to the nearest dollar. So this will be our sampling interval. So we're gonna pick 43 items. The first one we're gonna pick is at 37,209. The second one will be at whatever that is, twice that, was it 74,418 or something like that? So we're just gonna keep adding 37,209 and whichever one crosses it. And again, the higher dollar amounts are going to be more likely to cross that 37,209 threshold. And if we get one that's more than 37,209, it's 100% sure it'll be picked. Let's stop here. Any question on that thing? I'm gonna take a screenshot of that. But even though this is this is our first one, so it's a little more complex. But even though this is you gotta jump through a few hoops. This is way easier than picking the sample size for a classical sample. And there's a good reason for that. Classical sampling, your sample size depends on your standard deviation or variance. There is no variance here. Every dollar is worth one. It's one, every item in the sample is worth one. There is no standard deviation. It's kind of a wacky, it's a wacky method, but it's really good for some things. Okay, so let's stop here. And there's nothing to, no, there is turn in the Medtrans case thing. In the Medtrans case, it really is a landmark case for many professions, but certainly for auditing. Any questions? Okay, well, we'll pick up on this next week, and next week we might finish chapter 6. See if I cut it down enough. I'm trying to cut it down so I can do it in 2 classes, 6 and 7. Okay, any questions? You guys had enough? Oh, look at 5 minutes early. See? I don't want to know what you're gonna do with that extra 5 minutes, but all right, I will the exam is due this Friday, I think. Check just to make sure I'm not lying to you. Yeah. So if you have any, I know some of you have already got it in, but if you haven't, I got the exam in, try to get it in by this Friday. And yeah. Any questions? Okay, have a good night.
No, thank you, Professor. Good
Good
night.
night.
You guys.